This morning's presentation will be quite different to those we've presented here in Brisbane in previous years. The style will be much more relaxed. We hope the content, though, will be as insightful, as compelling as ever. There's four key areas we want to step you through this morning. The first will be some discussion about the economy, when and how will it recover here in Queensland and in Australia. We want to talk about that issue of capital. We think it's really central to the activity and the prospects for 2010. Then we'll look at each of the key research outlooks for each of the sectors, and I'll invite some of my colleagues here from Brisbane up to talk about how they see the market from the coalface. We'll finish up with obviously some conclusions and leave you with some directions on each of the sectors. So let's get started. The economy and capital. Start with the bigger picture drivers overall. This chart shows you our assumption about the economy here in Queensland and Australia, and indeed around the world. And it's interesting to compare, just how we sit in 2009, where Queensland has missed the recession, like Australia. But I think Queensland's been hit very hard by this downturn, and it's partly because there was such a rapid deceleration from such high levels of growth. Just 2.5 years ago, Queensland was enjoying GDP growth of over 6% per annum and leading the nation, along with Western Australia. This year, our assumption is growth here will be about 1%. So it's that rapid deceleration that all aspects of the economy and the property markets have ultimately felt, especially through the demand side underlying each of the key sectors. Our assumption is that by 2010, the economy here will be picking up again gradually and really moving into a more typical sort of average level of growth by 2011, and then really starting to fire again by 2012. So I guess the pattern of recovery here, and it's something you might want to remember, it's almost a theme coming through when we look at the material this morning. The pattern is for a gradual recovery, not an explosive recovery here in Queensland and indeed in Australia. What will the drivers be of the recovery? It's a question we often are asked by our clients. Well, we think there's a sort of 3 or 4 key areas that are really going to help Queensland turn around. The first is we noticed that residential construction in 2009 has actually been very low in Queensland, and it's a state that relies on heavy growth each year, and we think that sector will start to pick up again during next year and move into a more solid housing construction activity in 2011. So it's an important driver. It will start to come back next year. There's an industry in Queensland which is peculiar to the state, and we call it the industry of population growth. It really is an industry, and we talk a lot about the numbers of people coming to Queensland. It's a huge number every year. But hanging off that is an enormous amount of activity, demand for services and materials for the housing sector as well. So that industry will start to be felt again in 2010. We think there's going to be renewed demand for and investment in the resources sector. We're starting to feel it already, but beware of the potential for some softness going forward in the resources sector as China weans itself off the economic stimulus that the resources sector is now feeling. It's quite possible that there'll be some softness in the resources sector, a bit of a double dip in the next year or two. Having said that, though, we don't think the resources sector will go back to where it was. It'll be somewhere between where it is now and that high point. So still very important, and I think we'll see just exactly how that's going to impact the property markets as we talk through the details today. Infrastructure investment and engineering construction, especially engineering associated with mining, was one area that where the economic demand dropped quite severely this year. We think that's starting to come back already. And in some ways, the biggest amount of infrastructure investment is yet to come, especially in southeast Queensland, and it's an enormous demand driver for the occupational side, especially of commercial real estate. I guess really everything else just hangs off, we think, these 4 key areas for Queensland's outlook. So we'll leave the economy there for a moment, and let's turn to this question of capital. What are the sources of real estate capital? I mean, it's interesting, equity or debt. In the last 12 months, there's been an enormous amount of capital raised. It's quite surprising. I think the call went out, and $19 billion has been raised to recapitalise the REITs. We didn't really expect to see that happening, but there it is. There's $19 billion back through the A-REITs to recapitalise on the down valuations of properties held by the REITs. We know the superannuation funds are probably the biggest sleeper in commercial real estate. During the last couple of years, superannuation funds coming in have been going mostly into cash. We know that the amount of funds in cash is now roughly twice what it should be. $160 billion. Half of that, at some time in the future, is going to be reallocated out. If 10% of that goes to real estate, you might be talking about $8 billion of cash right there, ready to go into direct property. That would be almost a whole year's turnover in Australia of commercial real estate from a single source. You know, the foreign investors are still very interested in Australia. I think they're starting to understand the outlook and they have more belief in Australia in some ways than we do. And we've seen the German banks raising about 3 to 4 billion euros a year, and about 10% of that goes into real estate, especially into the Asia-Pacific region. We're seeing the sovereign wealth funds in the Middle East still have an enormous amount of capital, and they will at some point be interested in global diversification. We haven't seen the Chinese really invest directly into real estate yet, commercial real estate, and that's quite possible because we know they're very heavily capitalised as well. I guess the private investors have surprised us in the last 12 months, just how they've stepped up and been able to fill the void that institutions have left by their absence in the market. We've seen about $2 billion in direct purchases in 2008 from private investors. It's about 60% of all purchases now are to private investors in Australia. The final area, and I think it's probably the biggest unknown for 2010, is really what will domestic bank lending do. We know it's still well below the long-term averages. We know that there's a very strong relationship, a very clear relationship to the amount of debt in the markets and pricing. That's one of the keys, I think, that once we see bank lending start to come back, you'll get more direction and more strength in pricing and the potential for yields to start to tighten again and prices to rise. But it's still very much an unknown, and our assumption is that bank lending will come back only very slowly through 2010. So plenty of equity, I think, is the message. Still some question marks over debt in 2010.